Hi, everyone. Thanks for joining us for Investments 201. We'll give it just another minute or two as folks are going to continue to log in, and then we'll go ahead and kick it off. Okay, let's go ahead and get started. I know we have a lot of content today, so we want to jump right into it. Welcome, everyone, to the third session of our Financial Foundation Summer Series. Whether this is your first time joining us or you've been here for the past couple sessions, we're glad to have you here. My name is Emily Platt. I'm Vice President of Advisor Success at Wellspire Advisors, and I'll be moderating today's conversation and guiding us through Q&A a bit later. Before we dive into the content, just a quick note for those who are new. Wellspire is an independent fiduciary wealth management firm with over 20 offices around the country, managing more than $30 billion in assets. We work with high net worth and ultra high net worth families and individuals, offering planning, investment guidance, and ongoing support for, tailored to each client's goals. As we've shared on previous sessions a number of times, a big part of who we are is our commitment to education. And that really is the heart of this series. We created it to help demystify key financial concepts and empower you to feel more confident and informed when it comes to your wealth. So today we're building on earlier conversations, taking a deeper dive into investing with Investments 201. And if you missed the previous session, Investments 101, you will find a link to that recording in the follow-up email after today's session, as well as the slides from that session as well. On that note, we are recording today's session, so you'll find the recording, the slides, and a registration to our next session in the follow-up email that's going to come probably in the next day or two. And the next session, the final bit of the summer series, is going to be focused on family wealth conversations, which is going to take place on August 19th. We're excited to be joined today by two of our colleagues from the Wellspire investment team, Connor Darrell and Michaela Johnson, who will be walking us through today's discussion. As always, the Q&A box is open, so please don't hesitate to drop in your questions as they come in. We'll do our best to answer all of them during the Q&A portion at the end, and we'll definitely try and save time for that. With that, I'll hand it over to Michaela to kick things off.
I'll be kicking off. Sorry, Emily.
Connor.
So yeah, our 101 session was very much designed to be an introduction to the world of investing, and because of that was very basic in nature. But today we're going to build on a lot of that prerequisite knowledge and begin to fold in some of the more advanced concepts, introduce some of the math that sort of explains how and where returns come from, and then dive into some ideas around actually building a portfolio and ultimately managing it. And we'll touch on a few other kind of key concepts along the way. But either way, lots to unpack and might as well just get started. So first things first, just a quick recap of what we covered during our 101 session. We talked about why we invest in the first place. We discussed the power of compounding and why there's no better time to invest than the present. We also talked about some of the key asset classes, which in this presentation we will think of as the building blocks of a portfolio, with each of those components playing a specific role. And then we introduced the idea of diversification and what makes it so important. And we're going to expand greatly upon that idea here today. But first, I'm going to send it over to Michaela to introduce some of the psychological elements of investing that we think are sort of a important prerequisite for investors to be aware of, and before you even set out, you need to kind of have this in your mind.
Awesome. Thanks, Connor. Well, welcome back, everyone. Let's kick things off today by talking about something we don't always associate with investing, which is emotions. It's very normal to feel fear or excitement or even uncertainty when investing. Even the best investors do. But what's important is to understand how our brains process these complex emotions to make sense of it all. And our brains are actually wired to look for patterns to feel more in control. And that is where we see these cognitive biases show up. And these are mental shortcuts that might actually help in our daily life, but in investing, they can work against us. And that work against us by driving us to buy investments at a high when it feels safe, or selling investments at a low when it feels scary. And so we need to really start by understanding how we think and how that impacts our decisions. Awesome. So there are about 180 cognitive biases out there. So it's safe to say that we're all going to encounter at least one along the way of our investing journey. And the key to avoiding emotional traps isn't perfection, it's awareness. And so a few key examples of these emotional traps include the confirmation bias. So this is seeking out information that supports what we already believe. And this is, as an example, listening to only analysts who are bullish on a stock that you already own. So you're confirming your belief system. Mental accounting, which I do myself, it's very common, is treating money differently based on how we get it. So this could be spending a bonus freely because it feels quote unquote extra, even though it's actually part of our larger financial picture. And then third, the endowment effect is overvaluing something just because we own it, like holding on to a stock we inherited from our parents, even if it no longer fits our strategy. And then lastly, recency bias or effect. This is assuming what is happening now will continue to keep happening. And so this, for example, is like avoiding the market just because it's been falling. And so again, there's plenty of other biases out there, but it's important to recognize that, again, our brain is wired to make sense of the complexities of the world. And that's okay. And it's okay to feel emotional when it comes to investing. The key is awareness that these traps exist and stepping back and trying to think about your investing plan holistically. And we can actually quantify the cost of emotional investing. So this chart shows investor returns versus an asset category over a 10-year period. And what you can see, that fund return gap in orange across the board, investors consistently underperform the investments themselves. And so where does that gap really come from? Well, it comes from timing. And so investors, again, tend to buy when they're feeling optimistic and prices are actually higher, and sell when they are fearful or pessimistic and sell when prices are lower. And this is actually the opposite of what we want investors to do. And so to close that return gap, investors should first recognize that, again, these emotional traps exist. And secondly, build a financial plan that not only just to have a plan in place, but one that you feel that you can stick with and that you can actually work through when emotions are running high. So now let's take a look at the economy and market cycles.
Yeah, thanks, Michaela. So you'll see a lot of these quotes sort of interspersed throughout the presentation today. You might have noticed the one from Warren Buffett on the previous slide, but this is the only one we aren't attributing to a specific person. But ultimately, no matter who said it, they are wrong. Well, not completely wrong, but the statement is an overgeneralization when you're saying that the stock market is not the economy, because of course the economy influences the stock market. And these two charts sort of help to visualize that idea. So you think about what it means to own a stock and what it means to run a business. And it should be fairly intuitive that when the economy is humming along, that's good for business, that's good for profits, and good for stockholders. And you can see here on the left-hand side that generally speaking, when GDP, which is a way of just measuring how the economy is growing, when GDP is growing at a faster rate, so are corporate profits. That blue and orange line tends to move pretty closely together. And then on the right-hand side, we start to translate that concept back to the stock market and try to illustrate that over the long term, the stock market tends to grow at a rate that is fairly closely tied to how much those profits or those earnings, in Wall Street terminology, are actually growing themselves. And on the next slide, we'll walk through the kind of basic narrative on how the economy tends to evolve over time. And that, of course, has an influence on how markets perform. So economists like to refer to this as the business cycle, where you have this sort of boom and bust of economic activity that comes in waves. And the way I like to explain this is that you can sort of think of the economy as a balloon. And as economic activity picks up, the balloon inflates. But ultimately, there's a fixed capacity of activity that the economy can ultimately support before pressure builds up and the balloon eventually pops. And so you can kind of think of that expansionary period where business activity is booming, lots of people are optimistic, they're out buying things. That's when the balloon's inflating. But eventually you reach a point where unemployment is extremely low. There's no new workers available to come in and produce all the goods that people are increasingly demanding. And that's when you start to reach capacity. And that translates to the peak of the cycle. At that point, businesses are going to slow their hiring practices and maybe even begin to lay off workers as the demand for goods and services starts to roll over. And then you get that contraction there and in the economy, and that ultimately leads to a recession, which eventually bottoms, and you start the process all over again. And all through this process, markets are moving up and down, right? There's different asset classes that are going to perform differently in different parts of the economic cycle. And generally speaking, those expansionary periods, as you might imagine, are generally good for stocks. The contractionary periods tend to be better for bonds. And that's what makes stocks and bonds so complementary of one another, is that they move and perform differently during different periods of the cycle. But the economy doesn't operate in a bubble, right? There's all sorts of external factors that weigh on the economy over time. The most important ones for investors tend to be what's going on with monetary and fiscal policy. Monetary policy is what the Federal Reserve is in charge of. So they set interest rates and occasionally operate in controlling the money supply, with the primary goal of influencing employment and inflation. And their job is pretty complicated, but the best way to think about it is that if the Federal Reserve wants to give the economy a boost, they'll often reduce interest rates and make it easier to borrow. And that generally makes it cheaper and easier to start a new business. And that should theoretically provide new jobs, add a jolt to the economy, and get the system flowing again. And so that's sort of the biggest example of how the Fed fits in here. There's also fiscal policy. That's controlled by the government, primarily Congress and the president. And that's going to be things like tax policy, government spending on public works projects, and then the social safety net, things like unemployment benefits, et cetera. I think, the best example of what fiscal policy means, or a historical corollary at least, is the New Deal, which was passed during the Great Depression. I think that's probably one that a lot of people read about in history books, right? The government funded all these infrastructure projects in the middle of the Great Depression to try to influence the economy, create new jobs, with the idea that those jobs would lead to people spending more and helping the economy recover from the depths of the Depression. Ultimately, the goal of both fiscal and monetary policy, though, is to manage the economy on the margins and help to smooth out the ups and downs that we described on the previous slide, the ups and downs of the business cycle. Now, at present, we've sort of diverged from the conventional wisdom of this framework, and we're sort of just in this mode of perpetual fiscal stimulus. But the general idea has always been that you implement growth-friendly policies in an economic downturn to help support the economy, and then you turn those things off when the economy is on strong footing, so that you don't accelerate the boom cycle and approach that peak too quickly. And again, we've very much strayed away from that generalized idea, really, ever since the financial crisis. But those are the tools that markets keep a really close eye on over time, because they have a direct influence on economic activity. But with all that in mind, the next thing we want to do is build on some of those asset class level discussions that we had in 101, and walk through how to think about these things on a more granular level, with the idea that we're building up to actually assembling a portfolio and putting those puzzle pieces together.
Awesome. So like Connor said, let's recap 101 and what we covered. So we talked extensively about stocks and bonds. So in case you missed it, there's a quick refresher here. Stocks or equities represent ownership in a company. So they carry higher risk because shareholders are last in line if a company goes under. Whereas bonds are loans to a company or government. And since bondholders are repaid before shareholders, bonds tend to be less risky, but also offer usually a lower expected return and are held in the portfolio for stability. So again, at a portfolio level, stocks are used for growth potential, whereas bonds are often used for income and stability. And that's really the key to main differences between these two key asset classes, stocks and bonds. And so now let's dive a little bit deeper into both of these. So there's a lot going on the screen, so we can take it slow here and unpack what's happening. But basically, the stock market is huge. So to help make sense of it all, we actually can group stocks by geography, company size, sector, and style. And some of these are pretty straightforward. Geography is whether a company operates mostly in the US or internationally. Company size is how big a company is based on its total market value. So large cap companies would be your well-known, established, stable operation companies like Google or Amazon, where small cap companies would be smaller and less known to regular investors out there. Sector refers to the type of business. So a few sectors would be technology, healthcare, energy. There's plenty more out there. But lastly, and a little bit more nuanced, is style. So style asks, is the company expected to quickly grow its profits, or is it trading at a price seen as a good deal? And so growth stocks would be companies that are reinvesting profits back into the business and expected to grow quickly. And so a good example of this out there is NVIDIA, reinvesting its profits. You're buying NVIDIA for its growth potential. And versus a value company is seen as undervalued or trading at a good deal for the return potential and dividends it may be paying. And a good example of a value company would be Coca-Cola. And so diversifying across these categories helps manage risk and capture opportunity in different parts of the market. So now that we've established the universe of stocks, let's look at what each stock has in common, and that's where returns come from. So we can actually break up returns into three main parts. First, there's dividend yield. So that is the portion of a company's profits that gets paid out to investors as income. Second is earnings growth. So this is when a company grows its profits, its stock price usually follows. And this is one of the biggest drivers of long-term performance. If any of you attended 101, we talked about earnings growth being a huge component of long-term performance. And the gist of it is that the more a company earns, the more valuable it tends to become. So its price grows with it. And then dividend yield and earnings growth are both considered fundamentals. And that means they're tied directly to the business itself. So you can think of that. How much is the business making? How well is it doing? And how much is it sharing with shareholders? A third part, which is valuations, is separate from fundamentals. An evaluation multiple change is telling you how much investors are willing to pay for a company's earnings. Common one being price to earnings, or PE. You might have seen that out there posted on websites. And even if a company's profits stay the same, the stock price can still move just because people feel more or less confident about it. And so on the right-hand side, what you can see is the 2024 S&P 500 decomposition of returns, the three components: dividend yield, earnings growth, and PE change. And what you can see is that valuation changes played a pretty small part in 2024 S&P 500 returns. And valuation changes tend to be more volatile. Rather, dividend and earnings growth tend to be a more stable component of returns. And so this is why valuations are important to consider, because they can reflect investor sentiment, and it's important to pay attention to them because they can also tell us what do we expect from the stock in the future for returns. And so that brings us to the next slide here, valuations.
Yep. And so generally speaking, those, as Michaela said, those top two components of return, dividends and earnings growth, those are the most stable pieces of the equation. But the idea of valuation is really important. And that's what we're trying to illustrate and lay out here. So this table is just showing you historical equity market returns at different starting points based on valuation multiple. And we tend to use price to cash flow for these sorts of analyses instead of price to earnings, primarily because cash flows are harder to manipulate for financial executives. And it just sort of reduces the possibility of there being some fancy accounting that clouds the picture. But the story is the same whether you're using price to cash flow or price to earnings, or really any other valuation multiple metric that you may want to use. The story remains the same. So again, you can kind of see here that as you move down that left-hand column towards the higher historical multiples, those have historically translated to lower and lower returns going forward. Now, it should be noted that at present, the price to cash flow multiple on the S&P 500 is a little over 20 times and is very close to all-time highs. So if you're looking at this data, that doesn't bode very well for future returns. However, like many things in the world of investing, there is some nuance around that story that I think we'll just take a quick detour here and kind of talk through, just because we want to make sure that this is clear and that we're not making a call on where the S&P 500 is going. So there's some justification for equity markets commanding higher multiples now than they have in the past. And this is something that our team internally has been discussing a lot over the past couple of years as the equity market has become increasingly, quote unquote, expensive. And the chart on the right-hand side sort of illuminates what I'm trying to point out for us. So going back over the past 20 years, we have seen a 65% increase in the profitability of companies in the S&P 500. And that's not the total dollar value of profits, that's margins. So margins are expressed as a percentage of revenue. That is a material increase over just a 20-year period. That's a tremendous improvement in the profit generating capacity of businesses. And a lot of it has been driven by the tremendous growth of technology companies and the innovations that we've seen take place over the past 20 years. And to us, that helps to alleviate sort of some of the concerns that investors may have about equity markets being too expensive and equity multiples looking so much higher than they might have been previously. That doesn't mean that valuation doesn't matter anymore. It certainly does, which is why we're kind of highlighting this whole idea and spending 5 whole minutes on it. But we wanted to offer up this perspective to help address kind of one of the big elephants in the room right now when it comes to investing in stocks for the first time, right? If you're looking at this data and you're not thinking about the context around it, you might be nervous to add money to equities. And we want to make sure that we're kind of painting the picture here and illustrating that the long-term growth potential is as strong as it's ever been. There's very much, if you're a young investor looking to grow your wealth, you want to own equities. And we're going to kind of explain that more as we go further in the presentation.
And just like stocks, we can run this same exercise with bonds of breaking down the bond universe, which is actually larger than the stock universe. And so first we can break it up by issuer type, then by credit, and then by maturity. And so by issuer type, we're basically asking who's doing the borrowing. So it could be the US government, it could be a corporation, an agency like Fannie Mae, and that tells you a lot about the nature of the bond right off the bat. Then there's credit quality. So this is how likely the issuer itself is to pay back your money. Remember, you're loaning money to the government, the corporation, or the agency, and there is a risk that they do not pay you back. And so we need to measure the issuer's ability to repay that debt. And so when we think about it, investment grade bonds come from borrowers that are seen to be more reliable and carry less risk. So you can think of US Treasury bonds. The US government is still a reliable borrower and a lot safer than lending to a brand new company that might not make it, right? And that brand new company, then we can categorize as a high yield or junk bond. So again, riskier borrowers with higher default risk. But because of that default risk, because of you're taking the chance that you don't get repaid all of your money, we're talking about that they have to offer you a higher interest or a higher return for that. And then lastly, by maturity, this is how long until you get paid back. So we're talking short-term bonds mature less than 3 years, intermediate bonds 3 to 10 years, and long-term bonds go beyond 10. And so all of these categories respond differently in various market environments. And so understanding how bonds can differ really can help you build a bond strategy that fits your goals and fits your risk tolerance.
And then just as we did with equities, we can distill the bond market returns down into a few key inputs. But in the case of bonds, on the equity side, we talked about earnings, we talked about valuations, but the bond side is a little bit more driven by one thing, and that tends to be interest rates being far and away the most important variable. And that's what's at the bottom of this diagram, right? You think about what a bond is. It's a loan that pays you a fixed level of cash flow for a predetermined period of time. The size of that coupon income, as you might imagine, serves as sort of the starting point for determining what the return on a bond is going to look like going forward. And we have a chart on the next slide that visualizes this, but the other two pieces are related to changes in prevailing interest rates and how that changes the bond's price in the period between when it's bought and when it matures. And the way to think about that piece is, imagine you own a bond that pays you 5%. If interest rates now move and a new bond that's exactly the same as yours in every way, other than it was issued more recently and has a different coupon rate, perhaps in this case it's 6%, that 6% bond is relatively more attractive than your 5% bond. And so the price on your bond is going to have to decline to reflect that because it's not providing as much cash flow. What I just described is why for bonds, prices and yields move in opposite directions. And that's what we're capturing there at the top of the equation. And then the last piece is what's known as the spread. And that's a very similar concept, but the spread refers to how much more your bond yields as compared to a presumably risk-free bond. And oftentimes we're using treasuries as that base rate comparison. So theoretically, right, Michaela touched on this, if you're lending to a company that may go bankrupt, you should receive a higher yield than if you lent your money to a risk-free investment, which traditionally would be something, as I said, like a treasury bond. There may be events that take place or developments at the company level that impact the price of your bond relative to a risk-free investment, and that's going to be referred to as changes in spread. And those can have an impact on your return as well over a given holding period. And just to drive that concept home again, because I think it can be a little bit confusing, we're going to put this in like a personal finance terms, right? Think about getting a mortgage. Traditionally, if you have a higher credit score, you can get a better rate in your mortgage because you're viewed as a less risky borrower. It's the same concept as what we're describing here when it comes to credit risk. But again, far and away the most important factor in determining bond returns, and in fact largely the only factor if you're holding the bond to maturity, is that yield. It's that coupon. And that's what we're illustrating here on this next slide. So the blue bars here on this chart are the return on treasury bonds during each decade going back to the 60s. Then those yellow dots are the starting yield at the beginning of each of those decades. And you can see how closely those things track each other, right? That yellow dot tends to be near the top of the bar. And this also helps to highlight one of the interesting things about bond investing, because we just talked about how yields and prices move in opposite directions. So it might seem counterintuitive that returns and rates would be moving in the same direction. The reason for that is that as yields go up, you start to collect more income from your bonds. And that ultimately leads to higher returns over the long term. They may be, there may be some immediate losses in terms of price for reasons that I described earlier, but you make up for it in the long run in the form of that higher coupon income. And that's what's kind of being reflected here over time, is that coupon income is the primary driver of what ultimately happens over that investment horizon. Ultimately, bond math is tricky. We just walked through it pretty quickly. We wouldn't expect everyone to have a perfect understanding of all of these mechanics after just a brief discussion, but hopefully this was at least helpful in terms of understanding the contributing factors to bond returns over time. And we're happy to dive deeper with anybody that has follow-up questions on that during Q&A. The last asset class deep dive is alternatives. And we call alternatives the catch-all category because they really are a diverse array of investments, but we try to sort of break them into 4 overall categories, 2 of which in blue on the left-hand side there are your private investments, private equity, private credit. These can also be grouped in with stocks and bonds, but they are different enough that we're including them here. So those are your private markets access points to equity and credit. And a lot of those characteristics are the same as for stocks and bonds, but the investments are privately sourced, they're not available on public exchanges, and so they take on some different behaviors, some different characteristics that warrant them being included in a different category. These often have, technically, if you started your own business and borrowed money from relatives, that would actually be a private equity investment. Depending upon the terms of the agreement, it may be a private credit investment if you're planning on paying them back. But that's technically the type of structure we're looking at. Just in the case of the world of investments, it's usually a lot more sophisticated private investment negotiation going on. And then there's the non-traditional investments, right? You've got hedge funds is often the term thrown around there. We could probably do an entire session on those by themselves, but that's where you're going to see investment managers taking on, long and short positions in different public investments categories, and they may make bets on what's going to happen, whether they're going to go up or down. So the return stream ends up being much less tied to the overall performance of overall markets, and so they sort of get their own category. And then the last one here that I didn't mention yet is the real assets. So that's going to be anything that you could essentially, kick with your foot or drop on your foot. It's physical things like real estate, commodities, gold, etc., farmland, and those tend to be uniquely positioned as well because, what happens in the economy does not necessarily dictate how well a crop yield performs. And so we have to sort of find these different categories to put these investments in to kind of describe how they fit into a broader portfolio. And alternative sort of becomes the catch-all for these things that sit on the periphery and outside of the core asset classes that we talked about earlier. The last thing to note here are there are many different access points for private investments, which we highlight there on the right-hand side. Drawdown structures are investments where you commit to investing a certain amount of your money that is then called over time as the manager goes out and finds new investments. So it may take years to get all of your money invested, and you won't actually know exactly what you're investing in up front. I mean, you'll have a general idea of what they're trying to do, but the exact companies or the exact investments that they're going to source will not be known at the time you make your commitment. So it's a more of a due diligence process that becomes focused on the manager themselves, the person you'll be investing with, and there's a lot of work that goes into identifying the right partners in that context. There's also interval funds, which are more like traditional investment structures, except they only allow you to sell your stake at some regular window of time, typically quarterly. But they often will have a ticker associated with them. You can see them on your statement, and they will have a price that will move up and down in real time, whereas a drawdown structure is going to be a little bit less transparent. And then there's evergreen structures, which sort of split the difference between the two. The terms and the experience is very similar to an interval fund, where there's going to be more liquidity opportunities. There's going to be more opportunity to see what the portfolio is doing over time, but it's going to be privately sourced, and so won't necessarily have a ticker. So that's all things that you kind of get into the details. Like I said, this could be a whole session in and of itself, but we sort of describe this as a broad category because, again, it sits alongside the core assets of a portfolio.
Awesome. So now that we have talked through alternatives, we've talked through stocks and bonds and different asset classes, we want to tie everything together, right? Let's bring it all together. And in order to start really talking about portfolio implementation, we need to understand diversification at its core. And so when we talk about diversification, it's not just about throwing a mix of things together in your portfolio and saying, okay, I'm diversified. It's a lot more intentional than that. And real diversification means you're adding investments that each bring something different to the table, specifically different types of risk. And so take stocks and bonds, for example. They work well in a portfolio, as Connor mentioned before, because their returns come from different sources of risk. Stocks are mostly tied to market performance and overall economic structures and policies, where bonds, on the other hand, are more sensitive to interest rates and inflation. And so their returns are derived from different sources of risk, which increases portfolio diversification. And so that's why it's so important to know not just what you own, but understand why do you own it in your portfolio. And it really ties back to the basic truth of investing that without risk, there is no return. And so the key is making sure that you're taking on the right kinds of risks in your portfolio that match your goals and your risk tolerance and your capacity to handle that risk. And we can really define risk in three main metrics. The most common one is standard deviation, and this tells us how much is an investment's return bouncing around from its expected return or its average return. And you can use it for a single stock or a whole portfolio. A higher standard deviation just means there's more uncertainty in what kind of returns you might get. So things could swing higher or lower than expected. Another useful measure is max drawdown. And this one looks at the biggest drop from a peak, to a low point based on past data. And it gives you a sense of how bad things could get in a worst case scenario. So if we think back to 2008, where investments dropped sharply, specifically stocks, and the max drawdown then gives you a good picture of what a loss could look like and what it might feel like. And it's a great tool for checking on your risk tolerance. So could you really handle riding out a 50% drop in an individual stock? not just financially, but emotionally. And if not, then that might be a good indicator that it's time to reevaluate your portfolio and the risk you're taking on. And so finally, there's the concept of correlation. And this shows how one investment is moves compared to another. And in building a portfolio, we generally want assets that don't move together or have a negative correlation or a low correlation. We want the returns to move in opposite directions. And the reason for this is, yes, it is great when both of these assets in your portfolio outperform at the same time, but that also means that the assets are also likely to underperform at the same time, and that introduces risk into the portfolio.
And we can take these concepts that Michaela just described and actually start to put a portfolio together. And the way that we like to think about this, and we sort of just talked about it, is that everything in your portfolio should be there for a reason, right? It's like putting together a team. Every piece of the puzzle has a specific role that it's going to play in the portfolio. But broadly speaking, you can break things down, in our view, into two high-level types of roles. And you can almost think about this as offense versus defense. On one hand, you've got what we would refer to as your return-seeking assets. Those are your investments that are likely to appreciate the most over time, but may be more volatile. So that's going to be your equities and maybe your higher yield, riskier fixed income components. And then you've got your risk mitigating assets. And those are the components of your portfolio that are going to be relied upon to provide a ballast when there's a downturn in the economy and the markets are in flux. So that's going to be your high quality, safest bond investments, your cash. Those are the sorts of examples of assets that would fall into that category. And you can see here, we are trying to highlight kind of the three different statistical characteristics that Michaela just walked through and tie them into this concept. The risk mitigating asset is going to have lower standard deviations, lower drawdowns, and lower correlation to broader equity markets. And that's what makes them better diversifiers. And then we look at this at the portfolio level and sort of tie it all together in the aggregate. And we've got another quote here which suggests that diversification is about the closest thing you get in investing to a free lunch. And we've got some data here to help highlight that point. So I'm going to start on the right-hand side of this slide here where we've got these two tables. And on the top is a portfolio of 100% bonds. And that portfolio has a historical return of 4.33% and a standard deviation of 4.7%. If we take that same portfolio, take 20% of it and move that into stocks, our return goes up to 4.69%, but our standard deviation actually goes down. And that's the beauty of diversification. Stocks and bonds ebb and flow at different times, and the net effect, because they both produce positive return over the long term, is that we can actually improve our returns without increasing the overall risk of the portfolio by adding something to the portfolio that behaves differently. And through kind of advanced statistical modeling, we can plot all of these different theoretical portfolios with different combinations of assets on a chart along with their associated risks and returns and create what's referred to in the industry as an efficient frontier. And that's what is being shown on the left-hand side. All of those blue dots are portfolios that can be improved by finding a better mix of assets that might lead to better returns with the same risk or lower risk with the same returns. And that's all we're trying to do when we're building diversified portfolios is we're trying to utilize this math to our advantage and find a way to improve outcomes without taking on more risk. And that's what diversification helps us to do.
And so now that we've talked about an efficient portfolio and diversification, what does that mean and how can you go implement it as an investor? Well, it doesn't need to be complicated. There's a rule of thumb out there, and this is just one of many, but it's 100 minus your age equals the percent you allocate to equities. So if you're 20, that would mean roughly around 80% of equities and 20% in bonds. And if you're 80, it would be the opposite. And the idea here is that younger investors have more time to recover from market ups and downs, and they can afford to take on more risk. And as you get older, your focus starts to shift towards protecting your wealth that you've built and generating income from it. And it's not a perfect formula, but it's a useful starting point when you want to think about, okay, how can I build a portfolio? And how do I know what the right mix of stocks and bonds are for me? And another way to look at this is through the lens of your life stage. Specifically, are you an accumulator or are you a decumulator? And so, an accumulator is someone who is still working and actively adding to their investments. And you can actually think about your regular paycheck as sort of like a built-in fixed income stream, right? So that income's coming into you. And because you're thinking about that as, okay, that's my stability piece in my overall investment plan, that allows you to take on more investment risk on the equity side. And so you're kind of thinking about it in the sense of what stage of life I'm in and when do I need to start decumulating from my portfolio. And so, for example, here, this retiree retires at 65. And now they have to start drawing down from their portfolio. They no longer have a stable income stream coming in from a paycheck. And so that's why the portfolio then needs to do more of the heavy lifting and producing income so that you can continue the same lifestyle you had in your accumulation phase. And so again, helping understand what life stage you're in, what your risk tolerance is, can help align your investment strategy with your goals, your lifestyle, and move forward from there. And once you have your investment portfolio set up, unfortunately, you have to keep in mind that your portfolio tends to drift. And so let's say you have a 60-40 portfolio set up January of 2019. What you can see is that January 2019, I had 50% in US equities and 40% in bonds, 10% in international stocks. And now, fast forward to March of 2025, well, now my US stock portion has gone up to 62%. I didn't do anything. That stock portion has just gone up because US markets performed well over that time frame. And now that US stock portion makes up a larger portion of my portfolio, which then decreases my fixed income in my portfolio. Well, we just talked about how over time we need to be de-risking, but what's actually happening in our portfolio is that our portfolio is getting naturally riskier, which isn't a bad thing inherently because what happens is you can rebalance. And so today, if I was to go rebalance this portfolio, I would be able to sell off some of my stock positions at a high, which is what we want, right? We want to buy low, sell high. And then I would be able to buy into my fixed income position, which hasn't performed as well relative to the US equity position. And so this is really rebalancing, really brings things back in line, and it keeps your allocation aligned to your goals and naturally encourages the classic investing principle of buying low and selling high.
And then there's next couple slides, we'll dive into some of the more granular stuff when it comes to actually selecting investments and deciding where they go in your portfolio. So, we're going to talk about things like tax efficiency. It's something that we talk about a lot as a financial planning firm because it's top of mind for us. We're trying to help our clients navigate their financial lives and keep as much of their wealth as possible. Because ultimately that's what's most important. If you're losing a lot of your investment income to taxes, then you're not able to enjoy using it, right? So one way to be really thoughtful about tax management and integrating it into the portfolio construction process is to think about what types of investments you place in different types of accounts. And I think in one of our other sessions this summer, they covered account types and how they're treated differently by the government. And we as investors can use that to our advantage by placing the most tax inefficient assets, such as bonds, which pay primary income or primarily pay income that's taxed at ordinary income tax rates. We can put those in protected accounts like IRAs. On the contrary, we might place efficient assets like stocks or municipal bonds in taxable accounts because they're more likely to be subject to capital gains taxes, or in the case of municipal bonds, they're not taxed at all. So we're just trying to optimize for keeping as much as we can over time. The other piece with stocks is if you're owning it, for 20 plus years, you're not paying anything over those 20 plus years, right? Until you sell the stock, you don't have to worry about paying that capital gains on it. And so it becomes a really significant planning tool if you're using it in a taxable account to allow it to grow over time without having to pay those taxes. That ultimately ties back nicely, I think, to the idea of buying more aggressive investments when you're younger and have that longer time horizon. You put those stocks in that non-qualified or taxable account and let them run, right? That allows you to benefit from that, all the while looking to rebalance, as Michaela said. But these are things that on the margins can help you over the course of multiple decades keep a lot more of your assets than you might have otherwise. We've covered a lot of ground here, but I want to cover one of the other concepts of investing that I think becomes really top of mind as people actually go to determine what specific investments end up in their portfolio, and that's the idea of active versus passive investing. It's likely you've heard those terms thrown around before, and they simply refer to the process by which you will actually choose the investments in the portfolio or the process by which the manager you hire is going to do it. The simplest and cheapest way to invest is passively. And all that is you might buy a fund or an ETF that tracks a specific index. And when you do that, you're basically saying, I don't want to be in the business of figuring out what stocks are going to perform the best or what bonds are going to perform the best. I just want to own all of them and allow the market to sort of naturally do that work for me over time in the form of essentially rewarding the best performing stocks with a higher stock price over the long term. That approach is a lot easier, but it doesn't give you the chance to generate extra returns. So by contrast, you may want to be active. Maybe you have a good feeling about some stocks as compared to others, or you feel like you can identify an active manager who's highly skilled and can help you to find those stocks on your behalf. Then you might want to implement an active strategy. The downside there is that this approach is typically more expensive, right? You're going to have to pay someone either to go out and do that research and find those stocks for you, or you're going to have to go and do it yourself. You also run the risk of underperforming the market, right? You or whoever's choosing the stocks could be wrong. You could underperform. That's a risk. So as an investor, that's sort of something you kind of have to ask yourself is whether you would prefer a simple passive approach or you want to try to eke out some extra returns via an active strategy. And we at Wellspire implement in both ways. We have high-level thoughts on where we think it works best, and you can see them there under common uses. In our view, active managers have a higher success rate in bond investing than they do in stocks, and they have a higher success rate in small and mid cap or more niche strategies than they might in large cap. And that has to do with how efficient the marketplace has become. And you think about how much information is processed by the market in real time on any given day when news happens. And so those are things that we kind of think about a lot and where it might be best to implement active versus passive investing. But again, that's sort of our general philosophy. The last piece is comparing investment vehicles. This is a little bit more of a takeaway slide, but it walks through kind of 3 different ways you might actually access stocks or access bonds within your portfolio. The most common approach for people is to go and buy a few mutual funds or ETFs. They are largely similar with a few distinct characteristics. Mutual funds and ETFs are both basically a basket of stocks that's either going to be active or passively managed. But the difference is that ETFs actually trade during the day like a stock. So you can buy and sell it in the same day. A mutual fund is a more traditional kind of older school type investment structure. You get one price each day and you get that's the price you buy in or exit at. They often have higher fees because traditionally mutual funds tend to be more actively managed than ETFs. And so that's where you're getting the payment to sort of you're hiring someone to pick stocks or pick bonds on your behalf. The structure within a mutual fund also tends to be a little bit less tax efficient than an ETF. And so that might come back to the idea we talked about earlier about which accounts you might place these in. And then the last piece is the individual securities. And there's a lot of different ways you can do that. But obviously, you don't have to buy an ETF. You don't have to buy a mutual fund. You can, within your brokerage account, go out and buy an individual stock or buy 10 individual stocks. You can go buy bonds or treasuries. Those are things that you can do on your own, build your portfolio that way. That tends to be more complicated and more time consuming. And so our general advice for people starting out is to go a more simple route. But you also need to be careful about managing risk. You need to be careful about trading frequency. Sometimes you can rack up commissions and trading costs. So those are things to consider there as well. And then it can be tax inefficient if you're kind of turning that portfolio over in a taxable account and buying and selling very frequently. That can lead to a less efficient implementation if you're doing individual securities. So these are things that you kind of have to think through on your own, what fits your style, what fits your desires most. But our approach has typically been to recommend something a little bit more simple for those that are starting out. And typically that's going to be an ETF or a mutual fund. And you can choose to invest in a couple of them that will allocate to different asset classes, build your portfolio that way. Lastly, to kind of close things up, just a real quick review of what we talked about today. We started out with the behavioral aspect of things and highlighting that emotion is just a really important thing to be aware of. We all have biases, but being aware of those up front helps you to sort of, fight back against the negative impacts that they may have on your decision making over time. We want to talk about the economy, right? The economy does influence markets, and understanding, at what stage of the cycle we may be in can help you understand which assets in your portfolio are going to perform best and help you think about what mix of different assets will work best for your current situation. And then we talked about the building blocks of return, right? There's different things or different factors that drive returns over time, depending upon what asset class you're talking about. And that goes back to what Michaela pointed out earlier, is that the spirit of diversification, the true essence of it is that you're finding assets that expose you to different risks. Because in investing, there is no return without risk. It's the fundamental concept that I think we would most want to drive home today, is that those things are entirely related, and diversification is about diversifying risk. And the last piece, again, just balancing risk and return, thinking about it in a return or thinking about it in a portfolio construct, and how different parts of the portfolio can help you to achieve different levels of return versus risk. So now we've kind of talked through the basics. We did the one-on-one session. We're now on to, we just finished up our intermediate investing concepts. Now is the best time to get started investing. We talked about it last time. We'll reiterate that today. There is no time like the present to start. I think we do have one more presentation later this summer, and that's going to revolve around family wealth and sort of having these conversations with across generations, and hopefully to help kind of spread some of that education and think about things being proactive. So we hope you'll join us for those. And again, happy to kind of take Q&A this go around, and for anyone whose question doesn't get answered over the next 8 to 10 minutes, we will make sure that we follow up with everybody so that everybody's questions get answered. So thanks for joining us today.
Thanks, Connor. Thanks, Michaela. So we definitely have some questions coming in here. So the first one is asking about the Moody's downgrade of U.S. debt. So can you just walk us through the implications of the recent downgrade of government's credit outlook?
Yeah, I can definitely take this one, Emily. Well, in terms of short-term volatility, the market really seemed to shrug the downgrade off. And I think it's important to note that this is the last of the three major credit agencies to downgrade U.S. credits rating. So the move reflected, structural concerns about rising deficits, higher borrowing costs, and some political gridlock. And from a practical perspective, we think the expected impact is pretty minimal. Treasuries are still considered a safe haven, and while there's a potential for like a ripple effect into other bond issuers, there are still strong corporate fundamentals in strong municipal fundamentals as well. And so that makes the widespread impact less likely. And so what this downgrade makes, this downgrade in the headlines doesn't really point to an immediate crisis, but rather raises attention that there may be structural cracks. There's still the rising deficit, and then where we're likely to see more fiscal policy play a role in the upcoming year or two, or moving forward.
Yeah. Thanks, Michaela. On fiscal policy, we did have a question that came in regarding what is the current administration's fiscal policy?
Yeah, so the way we generally think about it is tax cuts and spending. So any increase to spending and any tax cuts that take place are expansionary for fiscal policy. So generally designed to drive growth forward. So based on the One Big Beautiful Bill and the tax cuts that were extended as part of it, we would consider that particular policy to be expansionary fiscal policy. That's not diving into timing or appropriateness of any of it, but that's the way we would look at it. Is generally anytime the government is increasing spending or cutting taxes, that would be viewed as expansionary.
Another question we had is around leveraged ETFs. So, what would be a good strategy to buy levered S&P 500 ETF the next time it dips? How would one pay off the interest?
So that gets very tricky. When you're dealing with leveraged ETFs, they're basically designed to be trading tools. And so we are not traders. We are long-term investors. I should say that first and foremost. And so it's not a tool that we like to use. But one thing you have to be really careful about with leveraged ETFs is they're basically designed to be held for one day. They will give you, so let's say you're doing a 2x levered ETF on the S&P 500. The S&P returns 1% that day, that ETF will return 2% that day, but it resets the next day. So over a long period, because you're resetting every day, let's say over 1 year, the stock market returned 10%. That levered ETF, highly unlikely that it returns 20. So it's because you're getting those intraday point-to-point moves, it becomes really, really tricky to anticipate or understand what might happen over the long term. So it's something you have to watch really, really closely. And typically not something I would use as a strategic, investment. If I felt like the market was going to go up, I would not use those unless I was trying to trade intraday. One thing you can do, which again gets into a little bit more advanced concepts, but I would be more inclined if I felt the market just dropped 20% and I wanted to speculate it was going to go up, I would use call options. That's a whole separate thing. That's not a specific recommendation, but that's going to be a better way to implement something like that because with options, you have a direct control over what your payoffs and risks look like. So that's something, if there's a specific situation to discuss, we're happy to do that offline.
Thanks, Connor. One question that came in, and maybe I'll give a little bit of clarity to it first and then ask the follow-up question. They asked, can I open multiple ETFs and mutual fund accounts with various companies and funds? So I think it's important to note that those are investment vehicles that are purchased inside of an investment account. So let's say you have an IRA, you can buy multiple ETFs, multiple mutual funds, all within those accounts. They're just methods to buy individual stocks, bonds, and packaged up, but you can access them through your account. So your taxable accounts, like your individual account at a brokerage firm or your IRA. But I think what's important, another follow-up question to this one that came in was around active versus passive. So mutual funds, let's say it's an active mutual fund or a passive ETF. What's the balance between the two? Do you go fully active? Do you go fully passive? Or is there a blended approach that would be typically best?
Yeah, I think like Connor alluded to earlier, that there at Wellspire, we do see active and passive working together as a blended approach. And so where do we actually then implement active versus passive? Well, if we think about the stock market, and US large caps specifically, those markets are highly efficient, right? So in many cases, passive strategies make the most sense, like tracking the S&P 500. But in areas where there are smaller companies and mid-sized companies, those markets tend to be less efficient. There's less information. There's more to find in those markets to capitalize on a return opportunity. And so that's where skilled managers come in and have more room to add value. And so in those areas of the market, that is where it can make most sense to do active management. And building on top of that, fixed income is another story on the active side, where the Bloomberg Egg, if you think about the Bloomberg Egg, only covers about half of the bond market. And so if we think about other parts of the bond market, we can actually use active management in this space, specifically to navigate credit and municipal bonds and structured products, because they just can get so complex. And like Connor talked about before, the active side on fixed income is you have to go out and pick those bonds. And so that's where a skilled manager plays such an important role. And for a majority of investors out there, passive does make sense. You're contributing to a 401k, and maybe those are the only fund options that are available. And that's okay too. It's just knowing what fits your needs and your sophistication, and your investment philosophy, really.
Yeah, thanks, Michaela. And we did have another question that came in around passive investing, and they asked what would happen if everyone passively invested? Would the market not function efficiently anymore? Your passive investing is, and to Michaela's point, you're investing in the market, right? So active managers are helping to try and outperform. The goal of it is to try and outperform the market. So it's not necessarily needed to make an efficient market, but it's opportunities for potential growth for investors who want to take on, who see opportunities in the market to be able to take on that additional potential risk, or just there's additional opportunities in the market, but it doesn't make a market efficient.
It's a very fun theoretical question. It's I've always thought about it as there is a point where, and I think you kind of touched on this, Emily, the incentive comes back for active managers to re-enter the market at some point before you get to 100% passive, because if everybody's just sitting there not watching anything, then markets essentially freeze up, and then new information about companies isn't processed, and that becomes an opportunity for somebody to come in and take advantage of that mispricing. And so I don't know where that theoretical sort of tipping point is, but it's somewhere less than 100%. And so it becomes highly unlikely that the market gets to that point, because at some point the active managers have tremendous amount of incentive to re-enter the market.
Thanks, Connor. So I know we are actually up on time. We're a minute over. So I want to thank everyone again for spending part of their day with us. You will be receiving a copy of this recording, the slides, in a follow-up email. It will also be posted on our WealthSpire website, and there'll be a link to join us for our next session on August 19th. If you are a WealthSpire client and want to explore any of these topics further, your advisor would be happy to connect with you. If you're not yet working with us and are curious about what we do, the follow-up email will also include a way to get in touch with us. Thank you again to Michaela and Connor for running this presentation today. And thank you again for everyone for joining us. We look forward to seeing you in the coming weeks. Thanks, everyone.